Mortgage interest rates change all the time, and if you've been trying to watch them and figure out when would be a good time to jump into the housing market based on interest rates, you're probably frustrated. After all, not only do rates change every day, but if you're going on different websites, looking at lenders, looking at the sample rates they're offering, those are just samples. They aren't specific to your situation. And by the time that you're actually ready to apply for pre-approval or even to get a mortgage, things are probably going to have changed. So what actually determines mortgage rates and what can you do to get a better one? Something that's been in the news a ton the past couple of years is the Federal Reserve. The Federal Reserve sets monetary policy for the entire country. So yes, they do play a role in things like mortgage interest rates. But when people talk about the Fed raising rates, they aren't talking about these kinds of interest rates specifically. What they're actually talking about is the federal funds rate, which is the rate that banks charge each other to borrow money overnight. When the federal funds rate goes down, it's less expensive to borrow money. When it goes up, borrowing gets more expensive. Why does the Fed want to make it harder to borrow money? Well, by making it pricier to buy big things, not just houses, but also cars, really anything that would involve financing. The idea is that demand will decrease and so prices will go down too. The federal funds rate is one tool that the Federal Reserve uses to try to steer the US economy. But, they also face unexpected things that can pop up along the road, like geopolitical events, elections, changes in consumer behavior. Lots of different things can happen. But in general, the Fed tries to be really predictable. And because of this, mortgage rates tend to not just move in concert with what the Federal Reserve does, but they'll honestly often have changed before the Fed has even made any moves. This is because the Fed likes to play things safe and very predictable. Economists and other experts know when the Federal Reserve is meeting, but they also have a very good idea of what's going to happen at these different meetings and what direction rates are going to go. So often, mortgage lenders will have made adjustments to their base rate before the Fed has even touched a thing. This is one reason why their surprise rate drop in March of 2020 was such a huge deal, because the Fed does not usually do surprises, and that came out of nowhere. So that's a bunch of big stuff you can't really control. What are things that are within your grasp that impact the mortgage rate you're offered? A big one is your credit score. Lenders are going to use your credit score as sort of a proxy for whether you're, good for the loan. Are you someone who's reliable, who they think is going to pay them back? Or, do you miss a bill sometimes? So if your credit score is already solid, you don't need to go wild trying to polish it up. But if you're in the fair or good credit bands, you might want to put some work into growing your score before applying for a mortgage. In general, the higher your credit score, the lower your interest rate. Looking at the 30 days before we made this video, the average rate on a 30-year conventional loan was 5.3% if you were a borrower with a credit score between 740 and 759. But if you were someone who was looking at the exact same loan and you had a credit score between 640 and 659, the average mortgage interest rate you'd be offered was 5.69%. That's a difference of almost 40 basis points, and that will really add up over the life of the loan. Another advantage of having a higher credit score is that if you're in a situation where you need to make a smaller down payment and you're going to have to pay mortgage insurance, a higher credit score can help you get a lower mortgage insurance premium. So let's say you're making a 3.5% down payment on a conventional loan and you've got that lower credit score of 640 to 659, you'd be looking at a mortgage insurance premium of something like 1.65%. But if we're doing the same loan, the same down payment, but we've got that credit score that's 100 points higher, 740 to 759, you are looking at a premium of 0.7%. Pretty big difference. Another factor that goes into determining the mortgage rate that you're offered is your loan to value ratio. Loan to value ratio is simply a ratio of how much you're borrowing, the loan, relative to the price that you're paying, aka the value. If you make a 3% down payment, you're at 97% loan to value. If you make a 20% down payment, that's 80% loan to value. That 20% down payment does allow you to skip mortgage insurance on a conventional loan. Additionally, lenders generally consider anything higher than an 80% loan to value ratio risky. And so making a smaller down payment may push up your interest. Another thing that can affect the interest rate you're offered is the type of home that you're buying. Homes like condominiums, second homes, investment properties, and manufactured homes can come with higher interest rates. That's just because lenders consider them slightly more risky than other home types. Last, the type of loan that you're using can impact your interest rate. If you've been browsing interest rates online, you may have noticed that you'll see different sample rates for conventional loans versus FHA loans or VA loans or other loan types. This really varies, so it's just something to look out for. Two types of loans that do pretty much always have higher interest rates, though, are jumbo loans and portfolio loans, because both of these are riskier for lenders for different reasons. So what can you actually do to influence the mortgage interest rate that you're offered? One, grow your credit. If you've already got a really solid credit score, you don't have to go wild trying to polish it. But if you're falling into the fair or good credit bands, you might want to build your credit before you start seeking mortgage pre-approvals. You can also try to make a larger down payment to affect that loan to value ratio. I know, where are you just going to get more money? I will tell you where you're going to get more money. Look into local and state first-time homebuyer programs, which can offer grants, aka free money, or low-interest loans to help with down payment assistance. Another thing to consider is buying points. Points are prepaid mortgage interest that you pay at closing, and each point usually equals 0.25% off of your interest rate. So for example, if you were starting with an interest rate of 5.5% and you bought 1 point, it would bring it down to 5.25%. That sounds awesome, but it's important to note that these are not cheap. 1 point usually costs you 1% of your loan amount. So say you had a $300,000 loan, a point is going to cost you $3,000. But on the other hand, since they are mortgage interest, they're tax deductible. Last, shop around. Mortgage rates are another place where you can be a smart shopper. Don't just go to one lender, compare multiple lenders, which, by the way, you can totally do that on NerdWallet. With information from multiple lenders, you can look at the combinations of interest rates and fees that you're offered to figure out which is going to be the best deal for you. Big picture, if you're considering getting into the housing market, there's a lot of news about rates out there, but don't get too hung up on them. Interest rates are just one part of home buying. Focus on the stuff that you can control, like getting your finances in order so that when you're ready to go for pre-approval, you're going to be a well-qualified candidate. Apply for pre-approval from multiple lenders, find the one that you like the most, and then once you've got it, just make sure that it stays up to date, especially if your home search is dragging on, so that you're always confident about how much you can actually borrow. And when you finally made it close to the finish line and you've got an offer accepted on a house, lock your rate as soon as you can so that it will stop moving because you've worked hard for it and you want to hang on to it. Hi, I'm Kate Wood and I write about mortgages and home buying for NerdWallet. If you've got questions about buying a home, drop them in the comments. We are happy to try to hook you up with resources from our website or even maybe follow up with another video. And if you learned something today, please hit like, subscribe to our channel if you haven't already.